To any investors setting up shop in a foreign country, the main target is to recoup investments made in the shortest time possible. A report by Frontier Strategy Group notes that Kenya ranks second in Africa as one of the most preferred investment destinations. But even as countries race to attract investors, experts say that they will avoid what will end up being a race to the bottom.
When you have a business operation in a particular country, you should be willing to pay a requisite amount of tax that is commensurate with the amount of revenue that you earn from that territory. And because, we say TP is jurisdictional, taxes are jurisdictional, you find that most revenue authorities will compete rather than collaborate.
Transfer pricing is a mode of accounting applied by multinational corporations developed by Organization for Economic Cooperation and Development. In Kenya, it's regulated by the Income Tax Act, Chapter 470, and was enacted in June 2006.
But the rest of the world has come to the idea that we are going to approach transfer pricing because it is so multinational. It always involves two countries, and those two countries should ultimately agree on one price. And in order to get that, we need to have some consistency. And so luckily, the governments around the world have largely adopted a consistent standard, which is the OECD guidelines.
The level of attention applied in this pricing has caused countries to develop guidelines on the mode of taxation. The Kenya Revenue Authority has conducted audits on multinationals to ensure compliance with the law.
For the last 25 years, the single biggest revenue earner for the tax authority, even in the US, has been on transfer pricing. So for us, we are very young in this space, and that really gives me some assurance that, and when I say we are going to be in interesting times going forward, I really mean it, because this is going to be relevant to us for the foreseeable future.
Corporations have been known to report their profit numbers in countries with favorable tax climate so as to report a fairer outlook in performance. These companies have been criticized for this sort of modality, a move called base erosion or profit shifting.
In the 1980s, there was the idea that tax shelters, and particularly places, Cayman Islands and other kinds of tax havens, were being used by multinationals to siphon off profits and to reduce their overall effective tax rate, and that was inappropriate. It was being done in inappropriate ways.
Further, the process to harmonize tax laws in East Africa may present low-hanging fruit to companies operating across borders.
That if we didn't have double tax treaties, we wouldn't have international trade. Double tax treaties allow us to have a world in which we have international trade, and they are absolutely fundamental to the success of our global network.